One of the most interesting but also challenging features of markets is that they are constantly in a state of flux. This constant change brings opportunity. Opportunity brings the potential for profit. However, we have to be able to identify what the change is that is occurring and to not fall into the trap of making easy assumptions about what we're observing. What has prompted this is this little news piece that popped up in my newsfeed last week. It's from the Australian Financial Review, and it talks about the switch in the ASX from financial services, namely banks, to resources. And accompanying the article was this performance comparison, which looks at the year-to-date performance of the financials index and resources index versus the ASX 200. As you can see, there's been a clear degree of outperformance by the financials this year, and resources have lagged. As is my wont when I'm presented with a chart like this, I tend to convert it to what I consider to be a more easily digestible format, and that is to give it the notion of what it would look like if I had invested $1 in each of these at the beginning of the year. And this is the result. I did not expect it to be different from what was presented by the AFR. I merely do this to make the comparison easier, and I find people find this easier as well. Assigning a dollar value to things does tend to clarify the mind and crystallize one's decision-making. Percentage change is often difficult for people to get a full grasp of. A change in a dollar value is very easy for us to grasp. However, I expanded out the basis for comparison. The earlier chart looked at the ASX 200, financials and resources. This looks at the ASX 300, financials and resources. I did not expect there to be any great difference, but whenever you are shifting up an index, it is worth just looking at the data just to make certain that there is not a nuance or subtlety that you've missed. Besides, I needed to do this for something I'm about to show you. One of the things we need to be aware of is that we can't make assumptions about what the data may or may not be telling us based upon very broad judgments, which is why we need to look for some degree of fidelity. Part of the problem when people talk about indices is we confuse this notion of homogeneous versus heterogeneous. This notion that when you look at an index, everything within the index is the same, that it has the same characteristics, it is of the same character. This is not true. Yes, some indices are more tightly correlated and packed than others, but there is still diversity within them, and we need to be aware of that diversity. If you're not aware of the diversity, then you may be making suboptimal decisions. So when we talk about the financial services index, the moment we talk about that, you mention the word financial, people think banks and they think the big four, and I will look at those in a moment. But the same is true of when we look at this notion of the resources index. You have to ask the question, what does that actually mean, and does it have any value as a basis for comparison? Given that when you consider the notion of a resource stock, it may be a gold miner, it might be a silver miner, it might be mining iron ore, it might be mining mineral sands, it might be looking for lithium. These are all quite different. Yes, I do know they fall into the category of digging holes looking for dirt, but there is a subtlety within that we need to be aware of. And I've spoken about this before when we've looked at this notion of secular bull markets. The last true secular bull market that we had was 2019, 2020, early 2021 with lithium. You would not assume that that bull market would flow through to iron ore miners. But when people try and communicate what is happening with an index, they use very broad language. And their language is very imprecise, and it does not convey a lot of information. With this notion of subtlety in mind, I redid my chart, but I put in there the All Ordinaries Gold sub-index. Yes, I know it comes from the All Ordinaries, but there is no ASX 300 gold sub-index. What you see is that gold stocks have only marginally underperformed the financials for year to date. And if the current bull market in gold itself continues, then they will overtake financial shares. So this notion of talking about resources as a single entity is an inherently flawed one. If we take a step back and we look at a broad brush view of commodities in general, and this is a league table I've grabbed that looks at a selection of commodities stretching from everything from feeder capital to heating oil to silver. If we are to look at the right-hand side, we see commodities we'd be familiar with: silver, gold, copper, aluminium, steel. Unfortunately, things like iron ore are missing from this, but they give you a sense that within resources themselves, there is variation in the commodities that drive the share price of instruments that are analogues of them. We can see that silver's been a better performer than gold, and gold has outperformed aluminium. So we have this notion that commodities are not a single entity. They are varied, and they have a very dynamic variability that we need to be aware of. So we have this problem. You can't talk about resources as a single entity, nor can you make a decision that you are going to put money on based upon such a broad generalisation. Part of the problem is the language that people use, and this is taken from the same article. And it talks about this notion of neutralising the hyper rally in bank shares. This immediately begs the question of, within financial services, has there been a hyper rally in bank shares? To which the answer is no. There has been a rally, but the language of hyperbole is a distraction and a misdirection. It forces you to think that something has occurred that has not. And we can see that when we look at the year-to-date performance in the banks themselves, and these are the big four. You can see that Westpac leads the way, up 43.13%. ANZ is bringing up the rear at plus 21.05%. This is not a hyper rally. When you look at the performance of the top performing shares in the All Ordinaries, these are middle of the road rallies. Yes, they are quite good, and they're certainly the best that the banks have seen for some time, because the banks are fairly moribund in their performance. But it is not a hyper rally. This leads to the problem of this notion of index weightings, which is something I've spoken about before. It is distortions in the market that occur because of the sheer size of a stock within an index. The big four banks dominate any index within which they sit. So their performance will have a disproportionate impact in what is occurring. This in turn might give you very much a variation of what is a false positive. The assumption that an entire index is doing something when it may not be, and we've seen this problem before. But this notion that when you mention financial services, people automatically thinking about banks is a suboptimal form of decision making, and it's a lazy form of analysis. If I look at the best performing shares in the financial services index, I find FND and I find ZIP. These are an order of magnitude better than the banks in their performance. So if I had simply gone on the broad brush language of there is an uber rally in banks, banks are the place to be, I would have ignored this. I would not have taken the time to look a little bit deeper. This notion of simply looking at an index is a first order decision. Yes, it does have value. It needs to be understood that it lacks fidelity. It's not a decision upon which you can put money unless you are an index trader. What you need to do is implement second and third order decision making that looks a little bit deeper and goes into the granularity of what is actually occurring. And what is actually occurring is, yes, there has been a rally in banks, but more importantly, there has been a bigger rally in second-tier providers of financial services. So we have this notion that nuance is important, that we need to understand that making a generalized statement about something is simply inadequate. Yes, it does convey some information, and I do understand that when you write a newspaper column, you are constrained for time, but it takes traders no time to look beyond that decision-making process. If we return to our notion of resource stocks, if I had assumed, based upon the performance of the index, that all resource stocks were performing badly, I would have missed out on the rally in gold and silver. I would not have seen that, or I would have, perhaps more foolishly, dismissed those stocks when they came up on whatever form of stock selection I use. So it's important to move beyond the lazy language and start to get an understanding of what is driving markets at various levels, not just at the surface level of what stocks might be driving an index because of their weighting, but more importantly, what stocks offer opportunity. If you don't do that, then your decision-making is suboptimal, and you introduce the friction of opportunity cost. And opportunity cost is very important. If you had not looked further in the financial services sector than simply assuming that you must buy a bank, then you would have missed these potential returns. And such returns would have had a dramatic effect on your performance. Yes, you could buy banks, and that is an effective decision, but it is not the best decision. In trading, what we're trying to do is to sharpen our edge so that the decisions we make are the best decisions possible for us based upon the totality of information, not based upon a single statement that is a very broad or global statement, because it is extremely difficult to make money from any form of global statement without understanding the nuance and subtlety of that statement